Hey guys, it's Chris and Oggie. We are live for our Monday Lunch and Learn on our buy and hold series. I'm just go back into a little introduction. I did it on the first video just in case you forgot. Oggie is a runs a property management company as well as being an investor that buy and holds his own properties. I have some as well. I just typically have done all short-term rentals. He has got more of the buy and hold for the long-term assets. So he's decided to jump on. This is episode 5. So today he's going to talk about what's a good deal for a buy and hold, and then how interest rates and the bonds affect pricing and everything that goes along with buying investment properties. So take it away, Oggie. What do you got for us?
All right, so I'll do a little short presentation on what's a good deal for me.
Okay.
Like, it's a conversation that everybody's asking. Hey, what should I buy? What's a good deal? So I wanted to put a little presentation in perspective so you guys can understand what I'm personally looking for and where what's a really, really good deal for me. So, and then let me share my screen. How do you do that, Chris?
Just I think at the plus button, share screen.
Yes.
And then it should bring it up on mine, and I'll add it to the video.
Yep. Give me a. Here you go.
Blah.
All right. So, what is the best deal? Let's talk about it. For me, it's not the location. It's not the price I'm buying it. It's not even the condition of the property. So, what I'm looking is how many properties can I buy with as less money from my pocket, less cash as possible. So, at the moment, this is my criteria of buying and holding properties, rental properties. How much cash is going to take out of my pocket to get these properties? And so to explain why I don't care about location, price, condition, I wanted to show you my thought process here and kind of explain why I'm going for this. So, all right. So in the previous topics we talked about here, we talked about the importance of leveraging your cash,
Right.
and borrowing money and buying as many properties as possible. So I wanted to show here, if you have a $100,000 to invest, what's going to take if you buy as many properties as possible, what's going to be your return. So I base this return on $100,000 investment cash and 20 years time. And why 20 years? Because every time when I'm looking to buy a property, what I'm looking for is where this property is going to, if this property is going to double in value the fastest. And based on our statistics, probably 4.5% increase of prices per year. It's going to take about 16, 17 years for any property to double in value if we have an average appreciation of 4 and 4.5%. So just 20 years. So let's say I buy one property cash with my $100,000. In 20 years, if this property doubles in value, that value is going to be 200,000. So I will make $100,000 profit in this investment, which I'm doubling the money. Perfect. It's great. But what if instead of buying one cash, I buy 5 properties. Each property is worth $100,000, and I just put 20% down payment, and I buy five properties. Then my portfolio of rental properties from the very beginning is 500,000. And in 20 years, these 5 properties for 500,000, it's gonna be $1 million. So I'm gonna invest 100,000, and then it's gonna double. 500,000 is gonna double in value, so I'm gonna make 500,000. I'm still investing. I'm still investing only $100,000, but now I'm making 5 times more. All
Right.
right, and this is just on a 20%. So let's go and start going even lower than that. What about if you do only 10% down payment on each property? So now, instead of buying 5, you can spread your initial down payment not on 5, but on 10 each one. And now your portfolio is worth $1 million. You still invested 100,000. That's your own money, your own cash out of a pocket, but you control a portfolio of $1 million. So in 20 years, let's say everything doubles in value. Now this portfolio, it's worth $2 million. You see, I still started with $100,000. I just spread the initial cash between more properties, twice more properties, and that's how I increased my return on the investment. So from 100,000, I made $1 million. So what about if we go even crazier than that? What about if you do 5% per property? So now $100,000, I can put 5% and I buy 20 properties. Now I control a portfolio of $2 million. 20 years go by, my portfolio doubles in value. Now my portfolio of 2 million is worth 4 million. And I still
Yes.
invested only $100,000 in
Yeah.
cash.
From the first example, you went from 200 all the way to 4 million.
4 million. And I used exactly the same amount of cash. Exactly the minimum amount of cash. But here's even the craziest thing. What about if you acquire the property and you have zero money out of your pocket
Infinite.
and becomes infinite return? Because infinite return for us, with Chris and me, that's no money out of a pocket. We control the asset forever and we make return forever. So the best deal for me is no personal cash left in the deal. And that's how I decide if I'm going to buy and hold a property. How much money do I need to put in, and how fast can I get my money out so I have 100% of other people's money into the house and I don't have any risk. I control the asset and I turn this asset into infinite return. So
Yeah. So obviously the goal is to go to buy some wholesale discounted deals where you can buy them, let's say 70 cents on the dollar, put your rehab in, and then do the refinance at 80, 85, whatever your loan could get, and you pull out 100% of the cash.
exactly. So of course, this sounds really easy, but there's a lot of restrictions. So you need to know how to do it the right way. So next week, on the Lunch and Learn, I will go through we call it burn on steroids.
Okay.
How we can buy these properties below market
Hence,
value and refinance them immediately next day and get
okay.
our money cash out. But also, we're going to go a little further because we work with a lot of wholesalers, fix and flippers, and these wholesalers wants to make a fee. I'm going to show you next week how you can get the property, refinance it, pay yourself a assignment fee, and hold the property with 100% of the bank's money and keep it as a rental. So then you turn this property into our infinite return. You have zero of your money into the deal. All the risk, most of the risk is shared between you and the bank, and you just hold the property and wait for everything to double in value. So So next week we'll talk about the burn on steroids. That's what we're going to talk.
Hence the shirt you've been wearing the entire time.
Yeah, burn on steroids. This is the basic trick. If you want to buy and hold rental properties, this is the thing that you have to learn. This is going to 10x your buying power, and you're going to get you to $10 million portfolio in a 1/3 of the time that usual investors do. So next week we're going to do this here for the Phoenix REIA, and maybe we can do it in person, some other classes too. But this is one of the main tools I use to build portfolios.
Awesome. So you talked a little bit before we jumped on about how the rates and how the bond market and all that's affecting the prices. And a lot of people have gotten front row seat of this over the last 2 years, and where interest rates were 2.5% and 3%, and prices are going crazy. And now that rates are, I think the 10 years bouncing around like 4, so I'd assume rates are like 6.25, right around there. But go into what you were talking about that.
When you buy and hold investor or investor in the real estate market, you have to know where the market is going, where the market is heading, so you can make the right decisions. At least you need to know like a 3-month perspective and maybe 3-year perspective. So what I was doing is I was doing our monthly write-up and predictions for our team, where the market is going for the next 3 months. And what we realize is that at the moment, the real estate market is controlled by only one thing, and that's the mortgage rates, nothing else. So let me what happened. So let's say we go back 3 months. Let's say what happened the last 3 months. In October, we got the rates jumping as high as 8%. And but at that time, this high interest rates just stopped all the demand. The demand is just sharply went down. But what saved us in the last 3 months is that we have a very, very low inventory. We had only like 15,000 listings on the market. Just for perspective, back in 2006, if you remember, Chris, when the previous crisis was happening, we had over 40,000 listings.
It was actually over 60.
Was it over 60? Okay.
Yeah.
And remember,
at
that
back
time,
in late 08, early 09.
But at that time, the populations of Maricopa County was 3.5 million. Now we are at 4.5 million. So we have more people with less listings available to buy. So that's practically what saved us from the prices going down. So for the last 3 months, the demand sharply went down. The sales slowed down big time, but the prices just adjust a little bit, not a lot. And that's because the demand was low. Now, what we're seeing is, the question is, in order to predict the next 3 months, we have to predict what the mortgage rates will be. So that's what is going to dictate the demand of properties. If the mortgage rates stay the same or go up, the demand is going to be low. If the mortgage rates go down, then we're going to have demand skyrocketing. And that's going to be the problem. Now all these buyers will be sitting on the outside waiting for the mortgage rates to drop in. Imagine if the mortgage rates go down quickly and all these buyers come into the market at a low inventory, it's going to be multiple offers again. So if we want to predict the market, in this case specifically, we need to know what the mortgage rates are, what mortgage rates is going to be. So now that's what make me talk to you about it and say, hey, what do you think about mortgage rates? What the discussion is, where the mortgage rates are going. And there's a lot of misconceptions here when people don't understand how the mortgage rates are dictated. Most people say, oh, the Federal Reserve is raising rates, and they automatically think the mortgage rates are going up. And actually, it's vice versa. Federal Reserve rates have nothing to do with the mortgage rates directly. They go the opposite way usually. That's what I've noticed, right,
Yeah,
Chris?
most people say that the 10-year bond already has, it's a slower moving target than the Fed rate. So everybody thinks that the 10-year bond already has um, the decreases already baked into it. And it's just, you know when money goes to bonds, rates go down, and
Yeah.
when money goes to stocks, rates go up. So
So yeah, exactly. Money goes to the big investors. It depends where the money goes. Do they go to the stock market or they go to the bond market? But now let's go back a little bit. How should we know where the investors are going to go and move the money? How are we going to predict that? So the only way to predict it is by trying to predict the inflation, where the inflation is going, because the inflation is the one that dictates the big investors if they put the money in the bond market or they don't put it in the bond market. For example, if they
yeah,
put it put it in a 30-year bond, T bonds, let's say they're at fixed rate, if it's 5, but inflation in the country is 8%, these bonds are very secure. You'll get your money, but 5% is not enough because the inflation is 8%. You
that's losing money.
practically you're losing
Yeah,
money. So that's why you're getting away from the bond market. But why investors like the bond market? Bond market is backed by the U.S. government, which is practically everybody thinks is the safest possible in the world, and you have a fixed rate. Also, you get paid every 6 months. That interest is get paid to you, so you get constant income, and so the safety is good in the bonds. But having a lot of inflation, that safety, yeah, it's not enough. So what happens is the big investors move the money from the 30-year T bonds and move into something else. And that something else is either stock market, which is doing good, or T bills. T bills is the other type of bonds, but they're short-term bonds, 2 days to about 10 days. The good thing
yeah,
with the T bonds, T bills, 10-year T bills, is that their their rate of return is based on the Federal Reserve rates. It goes up and down. So if the Federal Reserve rate is higher, then the return in the T bills is higher. So the big investors move the money from the 30-year fixed to the 10-year, which they're going to make more return. The problem with the T bills is that you don't get paid monthly for it, and it goes up and down. And you just have to wait to sell the T bills or wait for them to reach the 10 years to get paid. So in a certain time they're good, a certain time they're bad. So now let's talk about Feds. How the Feds deciding to raise the rate between the Federal Reserve rate. The only reason for them to um, raise that Federal Reserve rate is to try to control that inflation, because nobody likes inflation. Inflation is bad for everybody, for the economy, for the people, salaries, everything. So high inflation it's pretty bad. So
it
what
whittles
causes
away
inflation?
your.
Yeah. So there's so many things, like right now, what causes inflation? Inflation caused by a lot of money into the economy. When there's a lot of money available, there's a lot of transactions. People spend, and that's how the prices go up. So what Feds are trying to do is to slow down the flow of money in the economy, which is going to slow down the transactions, and people are going to spend less. You know, companies will produce less. They're going to need less workers. They're going to fire somebody. So all this slow down the economy actually causes a recession. But when it causes a recession, the inflation goes down. So when the inflation goes down, the T bills, the 10-year treasury also goes down. The mortgages become more enticed. Investors move the money to 30-year mortgages, and that's how the rates go down because the inflation goes down. So for us, recession in the country as a real estate investors is going to be good because mortgage
Voila.
rates will go down. So more
Yeah.
recession, better for us. But
So
so
yeah, with recession generally, yeah, better for us.
yeah, with the recession generally,
It
it's
also gives you,
mortgage rates
with the
will go down.
cheaper mortgage rates, it gives you, yeah. So, and generally when the mortgage rates go down, it gives you ability to take that, it helps your cash flow on your long-term rentals or even your short-term rentals, right? Because you get cheaper mortgage payments. So just helps your cash flow.
Yeah. 1% of the mortgage rate reduction is equal to 10% less of the price of the property. Then the payment is going to be exactly the same. So, but the
Right.
idea is when there's lower rates, all these people that are waiting on the sidelines, they're going to jump in. The demand on a low inventory is going to increase the prices. So that's what That's what I'm predicting for the next 3 months. We're going to have lower interest rates slowly going down, and the demand is going to be increasing, which is going to increase, lower the supply, and it's going to increase the prices.
Good old supply and demand.
Yeah, it's supply and demand. But everything right now is dictated by the mortgage rates. And the mortgage rates will be based on how the economy is doing in the inflation. So, guys, in the next 3 months, if you hear something negative about the economy, it means we're going to have good mortgage rates. If you hear something positive about the economy, then the mortgage rates will be going up. So, catch 22. Do you want to crash in the economy, or do you want it to not have recession or no recession? So,
yeah, and just a small example of that, we did get a job report late last week, and the 10-year was down around like 3.85, and it's bouncing around 4.2 just because. So you're talking 0.3%, 0.4% on your mortgage rates just because there was a good jobs report. I mean,
exactly.
not quite.
So, good job report means that people have jobs, which means they're going to have money, which means they're going to put more money into the economy, more transactions, which is going to raise the inflation up. However, the question is how accurate this job report is. So, I'm expecting in the next couple of weeks they're going to come and revise this job report because it was really bad, really bad. They realistically we lost 2.6 million jobs, but they used something called seasonal adjustment to revise it and make it positive. And I think the investors will take him, a week to catch up with all these numbers. So, yeah, but good news, bad news like this is just mortgage rates goes up and down, up and down.
Yeah.
And unfortunately, the Federal Reserve controls the information. So if you guys hear good news about the economy, that's bad news for the mortgages. If you hear bad news for the economy, that's good news for the mortgages. So, but I'm betting on recession, but I think the recession will be just in the economy, and I think this time real estate market will be spared from that recession.
Yeah, well, there you go. So little bit of economics, but yeah, I think just the mortgage rates or the 10-year bond's going to bounce. Maybe it dips into the upper threes. Maybe it jumps on to above 4 like it is right now. I think it's like 4.19 or just maybe 4.25. But anything.
So yeah, people to know what Chris is talking about. The T-bills, the 4.1, usually historically the mortgage rates are 2% higher than the 10-year Treasury bills.
Yeah. So, I kind of think that's going to just be like status quo. So I don't think your mortgage rates are going to see anything, in my opinion, anything crazy. Like they the 10-year dips to 3.75. Maybe you get mortgage rates at 5.75, but I think that's all you're going to see. I don't think you're going to see much less than that in 2020.
But that's always going to take. The moment we see rates with 5, starting with 5, we're going to get multiple offers again. It will be bidding wars again. So if you guys see mortgages with 5, you know what's going to happen.
Cool.
But it's going to take 3 months probably. It's going to take probably at least 3 months to see these prices going up.
Yeah. So what do you got for us next week, Oggie? What you were saying?
So we're going to be talking about BRRRR on steroids. This is a unique way
that's right.
to buy properties below market value. If you're a wholesaler, if you're a fix and flipper, you need to know this way of doing business, buying rental properties, because you can buy the property, create a lot of equity, have the bank financing 100%, and pay yourself assignment fee.
Yeah. So infinite returns, guys. So jump in with us next week, next Monday, and we're going to talk BRRRR on steroids. And basically that is buy a property, refinance it, get all your cash out, so you're getting infinite returns on all your rental properties. And then, generally we're not as bad here in Phoenix as 4.5%. We generally see a better rate than that, so we don't have to wait the whole 20 years for our properties to double. But
yeah, I think if you take into consideration 2006, the big crash, for that 20 years, 19 years back, the average appreciation is 4.5, including the big crash.
Yeah.
At that time, I think we had some 40% reduction. So Phoenix is one of these highly appreciating markets.
Well, thanks for jumping on, Oggie. We will see you next week with your BRRRR on steroids. Appreciate you sharing your insight.
Thank you, guys.
See you later
next week.